All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Mark Kimbrough.
Hey, hey.
It's 10 a.m. Pacific time here on June 6th. Hopefully, I've got my technology issues worked out and we're recording well here. No skips, but it's been a interesting week. We got the June gloom in full effect, Mark, and it's been painful. I
It's painful for you, but I'm clinging to the cool weather while I got it now. But
I guess that's true. It's better than the 100-degree weather.
let's just have we have a nice weekend lined up ahead of us, it seems. Let's hope that stays that way.
Yeah, my computer thought I was in Phoenix this morning, and it was like it's gonna be 103 today, and I was looking outside, and I was like, I don't think that's gonna happen. But we are one full week here into June. It feels like crazy, but we're almost halfway done with this year already. On the week, S&P up 1.3%. Looks like tech, the big winner, up 3%. The second place winner was energy, up 2%. And then comm services up 1.8. You did have four sectors negative, with the big loser, consumer staples, down 1.7%, utilities down 1.6%, and then consumer discretionary down 90 basis points. Kind of mixed week there, but overall a pretty good start to June there. Russell 1000 up 1.4, Russell 2000 up 3, growth up 1.8, and value up only 90 basis points. The year to date, though, S&P is still up 2.4%, so not great there, but it was looking a little bit bouncy there, and we're kind of back up to the positive territory, so that's always a good sign there, on a year to date basis. But it was a pretty data heavy week, so we'll get into that here in a second. But you have a pretty good vol across the board, especially if you kind of think about the bond market. A lot of bond market vol. You did end up, the 10-year is up 9 basis points on the week. The 2 years up 13 basis points on the week, and the long bonds up 2. As you would expect, that kind of led to the Bloomberg Ag down 30 basis points on the week. Government's down almost half a point. Agency mortgages down 40 basis points, and investment grade corporate bonds, the best performer, but still down 20 basis points. Ag up just over 2% on a year-to-date basis. We do have, I forgot to mention, the 10-year is at 4.49 right now. Long bond is still below 5 at 4.95. So pretty big moves, the way, pretty volatile week with, I guess, mostly Wednesday and today being the big market or the big yield moves on the 10-year. Yeah, go ahead, Mark. Yes.
Mentioning that 10-year at 4.5 right now, 4.49. I mean, like just yesterday, the low intraday was 4.33. So, I mean, 4.32 rounded. It's the vol indeed has been with us this week.
Yeah, but still, we were kind of been in this range. It hasn't been, it's not, bounce a lot of vol, obviously, on a day-to-day basis, but, we're kind of, we had that April low of like 4. We got to like 4.6 in May, and we're kind of right in the middle of that range. So kind of seems like a pretty range bound market.
Indeed.
Yeah, high yield bank loans high yields and bank loans up quarter point, EM up half a point. But really, you kind of think about year to date, ag's up 2%, government's up 2%, agencies up 2%, investment grade corporates up 2%, high yields up 3, bank loans up 2.75, and EM's up 3.5. All right there in line. It's all kind of basic. You earned your carry, right? So 10 years down 8 basis points on the year-to-date basis. Long bonds up 17. So if you kind of look at those longer duration side of things, canceling each other out, earn your carry. I guess that's one of the benefits of having a starting yield when you start the year, at a much higher yield than we were kind of used to pre-COVID. You can kind of weather some of that pain and still end up with a positive return. So fixed income, having some income helps. I guess that's a news flash for everybody. All right,
commodities. We were conditioned for years.
We were, and it is nice to be out of that kind of low yielding environment. Commodities, a good week, up 3.5%. All major sectors positive. Energy, the big winner, up 7%. Precious metals up almost 3%. And industrial metals up 2%. You have WTI crude oil up 6% on the week. We're at 64.50. So pretty big move. Everyone was talking about the death of crude oil, or OPEC Plus was going to flood the market and prices going to go down. to see a still kind of mid 60s is a pretty good move there, from WTI crude. Copper up three and three quarters, and gold up, only 1% at 33.23. Kind of seems like we've hit kind of a lull there, and kind of stuck in their range there for gold now. Stopped its kind of parabolic move.
Yeah, it needs to digest a little bit of that move. I mean, that's the consolidation needs to happen. That was a lot.
Yeah, obviously couldn't continue that trend forever, but certainly looking at a place where you're kind of like, okay, well, it's not the screaming buy it was. The momentum slowed, but maybe now's time for people to kind of digest it, as you kind of implied there, Mark. With that, that's kind of the market wrap up. Pretty quiet week. But why don't we get into the macro side, where we got today's Pizza Friday, so we did get some that jobs number. But early in the week there was some very important information also.
Yeah, it was a good week for jobs week in terms of just the volume of data. It's it's what we get once a month. But let's work our way through the week, and we'll recap what happened here. We'll start off on Monday, the non-jobs data point, one of them, but the ISM manufacturing for the month of May. This printed at 48.5. It was a point under estimates, 0.2 below the prior. Like, it's a small miss, continuation of a 3-month streak of contraction here for manufacturing. We did have a little 2-month flurry in the beginning of the year of expansion, but in general, we just continue to wait for the manufacturing thaw. Not worth dwelling on too many of the details here, but I mean, everything but 2 of the prints within the sub-indices were contractionary. I'll leave you with a quote here from one of the respondents here. It says, quote, "We've entered the waiting portion of the wait and see, it seems," end quote. So it's kind of, hey, steady as she drifts. People import a lot of goods. We're wait and see what's going to happen. What's, down the pipeline. There's still a lot of volatility to come. So in terms of trade policy and whatnot. So we'll see what happens. Moving forward to Tuesday, we got our first labor data point back in April. We got JOLTS job openings. This printed at 7.391 million. That was 291K above estimates and 191K above the prior. Look, nice to see it's above estimates, but it's still the second lowest print we have in the current downtrend from the kind of post-COVID recovery. But I'm going to try and give a little positive spin on this as well, because while it's the 12-month moving average has been consistently in decline every month for since 2022. Shorter term moving averages, you take a peek at those and maybe see, a little bend in the curve. And the 6-month moving average has actually increased for 4 of the last 6 months. So I'll, say that kind of helps support the argument that maybe the labor market is, at least in more equilibrium now than it was, a year ago. And the Fed has spoken to that. So this is also reflected in the ratio of job openings to unemployed. That ticked up this month to 1.03. And lastly, I'm going to trying to give a little positive spin to this data, but the brightest note here, you had the hires total that came in at 169K month over month. And it's the highest gain we've seen, actually the highest total number of hires since May of 2024. So we'll see how that trend develops. But in general, the JOLTS data still supports that kind of low turnover labor market, low hire, low fire labor market. Moves us forward to Wednesday, the always focused on ADP report, I say tongue in cheek. For the month of May, it printed 37K, well below estimates of 114K, and it was 23K below the prior. Usually, we look at this as an early look to the NFP report. Generally try and take it with a grain of salt, but this day the market did not, and bond market rallied somewhat sharply on this release. I'm going to give you a quote from the report. I'm going to give a couple quotes today, but the chief economist at the ADP said, quote, "After a strong start to the year, hiring is losing momentum. Pay growth, however, was little changed in May, holding at robust levels for both job stayers and job changers," end quote. So we had this report come through, rates rallied, and then the next data point for the morning was ISM services for the month of May, which kind of helped feed a little bit more of the rate rally. But we'll see how the week progresses after that. But it was a little shocking to see that big of a reaction to ADP reports, considering most people, it's generally dismissed a little bit. But
well, Mark, we were saying that because it was so weak, we were like, oh, payrolls are going to be strong. Joking on the trade desk, it's like, it's almost like a negative correlation to the NFP number or estimates.
Exactly. That's the level of dismissal generally that we give to this thing, which is why it was so shocking for the market to react the way it did. But it was not shocking to see what we got today, and I won't front run that data point quite yet. But yeah, further on Wednesday, again, we had the ISM services get released later in the morning after ADP. For the month of May, that printed at 49.9. Barely contractionary. That was 2.1 points below the estimate, 1.7 below the prior. It's the first time we've seen a sub 50 print since June of last year. You know what? I'm gonna give another quote here, probably my last quote of the day, but this is from the ISM Services Business Survey Committee, the chair of that. This is quote, May's PMI level is not indicative of a severe contraction, but rather uncertainty that is being expressed broadly among ISM Service Business Survey panelists, end quote. So like it's again, not going to dwell too much on this report. It's a slightly weak report. There's one angle that talked about a few months ago that still catches my eye, and that's backlog of orders. It's been in contraction for 9 of the past 10 months, while your business activity, your actual production of services, has been higher than new orders for 12 of the last 13 months. So at some point, you do run out of stockpiles of things to do if you're outpacing your new orders, but we're not at that point yet. It's just something to keep an eye on. Moving forward on Wednesday, later in the day, we had the Fed releasing the Beige Book. It's the 4th release of 8 this year. It's just good qualitative data they provide. National summary, I got 2 sentences for you. Uncertainty is restricting economic activity and hiring, and while prices increased at a moderate rate, there's expectations for that to accelerate in the months to come. That's tariff related. Let's see, moving forward to Thursday, we get the Challenger job cuts for the month of May. I don't like the year-over-year number that's reported here. It's 47% year-over-year, and that's distorted by a lot of those government job cuts that happened earlier in the year. But if you just focus in on the absolute total number of announcements for the private sector, it's in elevated territory. It's on the upper end of the range we've seen over the last year, and higher than we had in years prior. So this is kind of supporting the ongoing weakness in the labor market, the slight tightening that we're seeing. Also on Thursday, you got initial jobless claims, the week ending May 31st. This printed 247K. That's 12K above estimates, 8K above the prior. That brought the 4-week moving average up by 4,000 to 235K, highest since October of last year. You may remember October, we had a little bit of a scare that was going to be the big ramp up in unemployment, and it tapered back down as the year ended. So we'll see if this is another run up, how that works out. Continuing claims we got for the week ending May 24th. That printed at 1.904 million. That was 6K below estimates, 3K below the prior. This is making new highs in the 4-week moving average, new local highs. It ticked up to 1.895 million. That was an 8K increase from the prior week. Again, just continuing to track these. It's a very slow, gentle drift, but it's not drifting in the correct direction. So we'll continue to watch that weakening and see how that develops. And that brings us to today, Jobs Friday, aka Pizza Friday. We got the non-farm payrolls for the month of May. This came in at 139K, 13K above estimates, and 8K below the prior. So again, nice to see a beat here. The market did respond, reversing quite a bit of the movement we got, actually more than what we saw on Wednesday. But you know what? The beat is somewhat tempered down a little bit by the 2-month net revision down by 95K. Look, I still actually want to put a little positive spin on this data report. It's not a great print by no means. 135K is the 3-month moving average, but I did find it interesting. This month, all the gains came from the private sector. You had 140K in the private versus a 1K loss for government jobs, but all those gains were focused in the service providing sector. That's the meat of the economy. And that is the highest gain in service producing jobs we've had year to date. It's actually been accelerating for the last 3 months. So it's not exactly broad based this month. Most of those gains came in the education and health services sector, as well as the leisure and hospitality sector. So I'd put a lot more confidence in it if it was a little more broad based and we were on that trend. But this wasn't a bad print for NFP, and that at least was welcome. Maybe the expectations were a little too hampered by maybe some of the ADP and other inputs.
Yeah, and I think that this always shows the fact that the market looks at the headline number, the 139, and not like, oh, all these revisions. It's like the they all they focus on is that top line number.
Yeah,
market can't focus on. We always make the joke the market can't focus on more than one thing at once.
You're telling me you don't care that September data might have been revised?
Yeah, right. But like it's the net 2-month revision it's a pretty significant negative 95. So it's like,
Yeah.
It kind of almost confirms the, because you look at it, you go 139, probably be revised down, to, if you take 95, you figure, okay, maybe it was revised down by 50K. That's not a great number. And it almost confirms like the weak numbers that we had earlier in the week. But the market, rates up significantly today. The 10 years up or I'm sorry, rates are up, 10 years down, like 3/4 of a point on this move. And it's like, well, okay, but I think you're at a place now where people and you kind of you put your positive spin on a lot of that early data earlier in the week, and you can put the negative spin on the payroll data. And
Yeah.
I think that's what the market is doing. If you're bearish, you can put one spin on the data. If you're bullish, you can put another spin on the data. Um, and I guess right now it's the economy doing great, labor market doing great is winning at least for the week.
For the week. Yeah. That's why, I mean, you may have a little volatility in between, and that's when you zoom in on the chart and not take a big look backwards, but it kind of leaves you right where you started. I mean, very, very small, movement up in rates, but not a lot of move.
Yeah, and then I guess I probably am about to front run you here, but you look at the
Take it away.
unemployment rate. Unemployment rate is unchanged. The interesting part is labor force participation rate down by 20 basis points. Usually that doesn't move. Normally it doesn't move by more than like it's more normally flat.
It's incremental. It really
up a
is.
10, down a
Yeah.
10. Two seems like a pretty big move.
Well, we had
Um,
625,000 people drop out of the labor force. Where'd they
Right,
go? I mean, like
yeah.
what the
Like that's the only thing keeping the unemployment rate flat, right? And so you're really kind of like, okay, well maybe the market's not, or the labor market's not as strong as all the data would point to if you kind of look at the underlying
Yeah.
data.
Well, it was nice. Kimmel pointed it out this morning, but that unemployment rate, the U3 rate, just hung on to that round. It's 4.24%. We were so close to actually having a tick up, which would have made sense given that, but it is what
Yeah,
it
who
is.
knows if it had rounded to 4.3, who knows what would have happened.
The sell-off ensues. That's
Yeah.
But you know what? That summarized. I mean, that was the report, and you summarized that well. It's the big shocker was labor force participation rate coming in below expectations and having such a big decline. So it's not bringing up. This is the softening in the labor market. This is 1 month's data point. It's the household survey. This is a week one, and the last two were decent. But look, this is the ongoing gradual softening in the labor market, and this data on trend supports that. And that wraps up the week. And later today we do have what's it called? Consumer credit coming out, but that comes out at noon Pacific time, so a little late.
A little late yeah. And with that, if we kind of look at how the market's reacting, or let's look at Fed funds futures specifically. After the week data on Wednesday, we had over 100% chance of a Fed cut in September. And after today, we're back down to like 70, call it 72% chance. And no chance here we got a meeting in 12 days on June 18th. No chance of a cut in the July 30th meeting. So really September was the first chance for a cut. We're at 72% chance. Obviously, we'll kind of wait and see what happens over the summer. And after Jackson Hole probably sets the stage for a move, either, 100% or 0% chance, I would say, in what the market is going to price in after Jackson Hole. We're looking at 1.78 cuts priced in this year. So it was over 2 earlier in the week, kind of dialed that back down again today. And it really does seem like, we're kind of in that camp of 1 to 2 in for the year. And, I think it's much more like if we start to get really big slowdowns in labor, in the labor market, then you could see larger cuts. President was out saying Powell needs to cut for a full point. So that would be 4 cuts. And maybe, we get that if the labor market collapses.
If we're getting that negative NFP prints.
Yeah, we got to get some negative NFP prints or something like that would really freak out the market and the Fed. So short of that, though, I think you're in the like, okay, well, I'm on the side of probably less cuts. I think we get no cuts this year if the labor market kind of stays the same.
If it seems like the pricing is going to suggest it's going to reflect the people who are betting on 3 or 4 cuts, and then those who are in your camp on saying 0. Which if things stay steady how they look, 0 is a very reasonable expectation.
Yeah. And with that, I guess we get some more data next week. We do get it is inflation week next week.
Yes.
So we get CPI on Wednesday. Looks like the month-over-month number is expected to be 20 basis points. Core CPI expected to be 30 basis points. That's up 1/10 from last month. If we get that, core CPI would be at 2.9. So and up from 2.8. So that's the wrong direction for the Fed. Headline 2.5 versus 2.3 last month. So obviously that's a very important data point. The problem is that we have like a 0.0 rolling off for headline CPI. We got a 0.1 rolling off for core. And that's like over the next, 2 or 3 months, we got really, really low CPI numbers rolling off. So that year-over-year number is going to have a real hard time coming down.
We got the base effects.
That's right. And that's what, it never goes down. It's always, monotonically increasing. If we go to, we do get PPI on Thursday. That's expected to be a 0.2. It was a negative 0.5 last month. So back to the positive trend there. PPI ex food and energy 0.3, up from a negative 0.4 last month. And that kind of puts PPI at 3.1, or PPI ex food and energy at 3.1. So again, not the right direction for the Fed. It'll be interesting to see what the jobless claims numbers are on Thursday. That trend, I saw someone had like a 52-week trend of the jobless claims numbers, or I can't remember if it was jobless, if it was continuing claims or initial claims, but it was like just slightly ticking up. Obviously, it's been super flat for very long because this number has been pretty steady as she drifts, and it's starting to tick up a little bit. But it'll be interesting to see whether that trend continues, maybe as a worrisome point for the Fed, or we kind of stay, get a little bit of a drawback down on there in the jobless claims numbers. And then we get the June preliminary inflation numbers, really the things we're going to look at from the University of Michigan on Friday. We don't have any estimates out for that yet, but that number is pretty crazy. It's always it was 4.2 last month for the long-term inflation, 6.6 for the 1-year inflation expectations. And that was, peak, or well, it wasn't peak, but it was like, okay, tariffs was on people's minds. Now that tariffs are, I guess that the taco trade is coming out more, that maybe we'll see that inflation come back down as maybe tariffs are not as likely as they were last month.
Well, at least hopefully from these extreme levels, the 6.6 1-year estimate is pretty high. So it'd be nice to see that settle down a little bit.
Yeah, to maybe something a little more realistic, I would say.
Agreed.
All right, with that, I think, Mark, that wraps it up for this week.
Yes, thanks to all our listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes, or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yeah, don't forget our YouTube channel is youtube.com/DoubleLineCapital. We have a couple videos up this week. We have Ken Shinoda on his latest Channel 11 show. We have Jeff Sherman's CNBC appearance from earlier in the week. Highly recommend both of those. We did get a message from listener Rich again. We got it, I guess, on Saturday, asking about Jamie Dimon and the crack in the bond market. And I would say, and he wanted to know, does Mr. Gunlock have any thoughts on this? And I would say, Rich, you should tune in on Tuesday at 1:15 for Mr. Gunlock's webcast. I'm sure that he's going to talk about the bond market, considering it's a total return webcast there. So thanks everyone for tuning in, and hope everyone has a great weekend.
Yeah, thanks everyone out there. Stay safe.